Hello everyone and welcome to my channel Event Alpha, where I cover the S&P 500, factors that affect it, and provide intriguing quantitative triggers on individual names in that index that have had strong historical performances. We have a lot to cover today, so let's get right into the video. Like we talked about last week, the Fed announced their decision on the federal funds rate on December 10th, in which they decided to cut the rate by 25 basis points, lowering the target range to 3.5 to 3.75%, making the third consecutive rate cut in 2025. Now, the median FOMC forecast projects only one rate cut in 2026, with improved GDP growth and slightly lower inflation expectations next year relative to earlier projections. In Powell's press meeting afterwards, he expressed dovish language in which he acknowledged downside risks to employment and reasons to support rate cuts, in which most interpreted his comments and revisions to forecasts as supportive of further easing later on. This is an important point to note for later policy decisions, as markets may have priced in the possibility of additional cuts beyond the Fed's expectation due to the weakening labor market that we're seeing, ultimately impacting the strength of reactions to announcements to policy shifts. Inflation remains above their target, and uncertainty about outlook remains elevated despite the lower revisions in inflation expectations. Similar to the language he has used the past few meetings, he noted they will remain cautious in watching how jobs and inflation data evolve before they make any further decisions. In summary, Powell warns of a no-risk-free path in the situation because the policy solutions for increasing inflation and a weakening labor market are counterintuitive to each other. One problem will have to be solved at the cost of the other, potentially becoming worse or remaining bad. Now, today, December 16th, the U.S. non-farm payrolls, retail sales month over month, and unemployment rate were released. Non-farm payrolls printed at 64,000 jobs. Added versus the 50,000 expected. While this is great as the economy delivered more than expected, October's print had a very large negative revision down to 105,000 jobs lost, showing a much softer labor market condition overall than initially assumed. In addition, jobs data is weak relative to earlier months, showing a slowdown in expansion despite beating those payroll expectations. When looking at retail sales month over month, we came out flat at 0% versus the 0.1% expected, signaling weaker consumer momentum, which can dampen growth expectations and performance. This is particularly bad for the consumer discretionary sector, as consumer momentum and strength is pinnacle for sales performance, especially leading into a major holiday. We want to see a strong trajectory of appetite from consumers. Lastly, the unemployment rate came out at 4.6% versus the 4.4 to 4.5% expected, which is generally bad for the market as unemployment rose more than expected. In addition, it hit the highest level in 4 years, ultimately making a case for seeing more than one cut next year, like we discussed previously. In summary, the negative surprise in retail sales and unemployment seems to have somewhat outweighed the positives from the positive surprise in payrolls, leaving the market sentiment as cautious to slightly negative for the near future. Coming up this Thursday, December 18th, is our release for CPI and jobless claims at 8:30 a.m. It is incredibly important to pay attention to these two releases, especially given the price action of the S&P you will see in the next portion of the video. We want to see our inflation rate and jobless claims lower than the consensus if we are to see further bullish momentum past all-time highs, given they will further indicate the strength of the two pending issues the Fed is concerned about the most, inflation and the labor market. Okay, so here I have the chart from last week. Last week we had discussed S&P breaking out of a falling wedge pattern, in which that ultimately signifies further bullish momentum. As we can see on December 10th with the Fed policy decision to cut 25 basis points, the market reacted fairly positively, and we ultimately went on to test the resistance points we discussed last week, one being this swing high around 68.68, and the other around 69.15. As you can see, we broke the initial swing high but failed to breach our all-time high and rejected back down below this diagonal support. Now, we had discussed if the diagonal support had broken, we were likely heading back down to our prior all-time high that was broken and that we failed to sustain, and still have yet to see if it will sustain above. As you can see, it didn't hold here, as well as currently it's holding, but it may not in the near future. We'll have to wait and see. Now, if I go ahead and draw the Fibonacci retracement levels from last video as well, and we actually have a new high, so it actually extended up, and our 38.2% levels is a bit higher now. But ultimately, it still holds true. Our 38.2 level has been tested, and now the idea is for it to hold here. Now that we've broken out and we're retesting this diagonal resistance that's now support. If we do see this break, generally that's a sign we're probably going to see S&P test some of these lower retracements. And a good rule of thumb to have when working with the retracements is if you retrace down to the 50% retracement level and break through it, there's a really good chance that you are breaking all the way back down to the bottom, or all the way, retracing all the way from your previous move. And so that would place it right around, the bottom of this falling wedge that we had seen broken leading into December. Now, in terms of future levels to pay attention to, now we can go ahead and draw a new resistance, which now becomes more of a parallel channel than a falling wedge. And we're really going to want to see our price hold around this 38.2 retracement level and prior all-time high. This will be a really good indication of where we are going next, whether we bounce and go on to retest this newly created resistance, or if we fall back down all the way to the bottom of our range. So the last thing I wanted to touch on for S&P price action was the RSI trend channel we discussed last week. Ultimately, we had noted there had been some bearish divergence that had been playing out whenever we were retesting the resistance of this trend channel. As you can see, we went on to test it and break it again, similar to November. However, we failed to sustain, in which we broke right back down below it. As you can see, the day we did, Friday the 12th, ultimately the price continued to barrel back down to that 38.2 retracement level we were eyeballing. Now, from this point, ultimately, we could see RSI drop all the way back down to 30, and to complete the trend channel and ultimately have a oversold signal, as we haven't had one in over 8 months. And so you're really going to want to be paying attention to this support level here, as well as what it does with RSI at 50. We see we have some support there, and ultimately we want to see it break back out for any further signs of bullish momentum. Otherwise, chances are we are breaking this retracement level and going on to lower ones. Another thing I wanted to highlight today is our U.S. 10-year Treasury yields. Now, generally speaking, if you're a bull in the stock market, you want to see Treasury yields go lower. Lower Treasury yields are generally good for the stock market, primarily because they reduce corporate borrowing costs. They make stocks yields or returns more attractive relative to bonds, as if yields are lowering for bonds, they can't generate as much compared to stock returns. And also, lower yields increase the present value of future corporate earnings. So generally speaking, we have a resistance zone that is attempting to break at the moment. We see it has rejected 3 times now. We had 3 contact points in recent times. As you can see over time, or at least over the course of the year, these support/resistance points have been great levels just to identify pivots, right? And so ultimately, for bullish investors, you're going to want to see yields break back down below and reverse, and maybe go on to test the support here, or even lower supports around 3.9. Looking at the seasonality of the S&P, here I have equal weighted monthly returns, um, grouped by month and by year. I like to look at equal weighted returns for seasonality as to not get fooled by skewed data due to market cap structure, such as the environment we're in now, where the S&P is majorly impacted by a small fraction of the constituents, hiding the true nature of the S&P's performance or generally how stocks are moving as a whole. As you can see, November tends to be the strongest of months when looking at equally weighted returns, with our most recent November being the second weakest since 2016. So, not as much strength leading into December as we have seen historically happen the majority of the past 10 years. Now, looking at December, the average performance over the past 9 years is fairly neutral, leaving us with little from past performance to help determine how the rest of our December may go. However, what we do know is 66% of the time, when looking at December's over the past 9 years, the S&P went up. And ultimately, we'll see how the 10th year records on December 31st. To summarize, the main point I want to get across is contrary to months like July or November, where not only are you seeing the highest average returns, but also the most consistent win percentage basis. December is fairly choppy, right? Our average return is fairly neutral, and while slightly more months have increased and decreased, this is definitely a month you want to tread cautiously moving forward, as history shows. It's not necessarily one of our best months in terms of seasonality. Now, taking a look at the equal weighted returns of S&P sectors over various time periods, we can see that over the past month, consumer discretionary, financials, industrials, materials, infotech, and consumer staples have had the strongest average moves up, with continued strength over the past week for consumer discretionary and staples, financials, industrials, and materials. Today we had mixed reaction due to the economic releases and also due to possible profit taking over the past 2 days, given the concerns of overvaluations in the tech sector. All the sectors today had fairly moderate reactions, being break even or slightly down. The main thing I want to emphasize here is that over the past month, we're seeing strength in those top 6 sectors mentioned, and ultimately continued strength over the past 5 days. Today's reaction is relatively weak compared to the strength that we've seen, and so hopefully should our economic release on Thursday be more positive and the S&P gain a bit more of a positive sentiment, should we see a continued outperformance or strong performance in those sectors. The first stock I wanted to talk about is KKR. KKR is a global alternative asset manager that invests across private equity, credit, real assets, and insurance. KKR raises money from institutions and wealthy investors and invests it across private markets to generate long-term returns. Private equity being their flagship business and a major profit driver, they have a massive assets under management of $723 billion, putting them in the top 5 largest alternative investment firms. They make money from management and performance fees, along with investment income from their own balance sheet investments. So in other words, they benefit greatly by increasing the amount of capital they manage for investors. In their most recent earnings report for Q3, they reported a very strong $43 billion in new capital raised, mainly driven by its credit business, leading to reported record fee-related and operating earnings report. They reported an adjusted net income of $1.40 a share versus the $1.30 a share consensus, a surprise about 8.5%. Now, investors decide to start rotating back into financials and alternative asset managers in the backdrop of lower bond yields, improving economic growth expectations, and a stable credit market. This could be great for KKR, as their strongly growing credit business benefits from tighter spreads, and their fundraising capabilities will likely improve even more so than they already have as investors gain more confidence in the market. When looking at the outlook of Fed policy, if the Fed continues to cut rates past the one cut expectation in 2026, this is great for KKR as it reduces borrowing costs for leveraged buyouts and credit support, as well as boosts valuations in private markets. Ultimately, from a fundamental perspective, when we begin to see sentiment around the economy turn around to the upside, investors typically increase risk exposure to growth-linked assets such as private equity, making a great bull case for KKR should these next couple weeks and months we see economic print start to improve and the sentiment begin to turn around after we've had such a negative 2 months during this pullback and attempt of recovery. So I have KKR's price action over the past 10 years in the top panel, and in the bottom panel I have MACD, which is a measurement of the spread between two moving averages. Generally, you can use MACD to understand there's a shift in momentum and likely a continuation in that direction. Now, to keep it really simple, whenever the white line crosses above the red line in the second panel, that's generally a buy signal. And when the white line crosses back below the red line, that's generally a sell signal. And specifically for KKR, we can see that there's been 9 times we've had a MACD cross. Granted, MACD was less than 5%. And each time that occurred, KKR rose 13.8% on average over the next 70 trading days at a win rate of about 90%. And it was also performing with a profit factor of 3, meaning your wins historically were 3 times larger than your losses on average, requiring a 25% win rate to break even. Granted, it's been performing at 90% win rate, as more than beats that 25%, making historically a profitable trigger. Now here we're visualizing all the reactions of those MACD triggers, in which the x-axis is trading days out from the event on day 0 being the MACD cross, and on the y-axis we have the cumulative percent change over that time frame. So essentially what you're seeing is if you were to buy on the day the MACD cross occurred and then hold for 100 days, this would be your cumulative performance over that time frame. Now in blue we have the average performance across all the triggers, in which you can see leading up to the 70th day is where we lead to the 13.8% on average, and only one of the circumstances actually being at a loss, making it that 90% win rate historically. The last thing I want to point your attention to is the first 20 days, in which you can see drawdowns as much as about 7%. And so just bear that in mind. If you were to play this trigger, you may see lower prices from the trigger price before the price ultimately rises closer to that average on the 70th day. So I went ahead and plotted KKR's price action and what that 13.8% average move would look like if it occurred from the trigger price of 134.81. So that would bring us to a price of about 153.42, and very close in line with our prior high that occurred in August of this year. And I set up the risk structure 3 to 1. So that's about a downside risk of 4.5% to respect that 3 to 1 risk structure rule. I also went ahead and plotted some support and resistance points that could be helpful. First being we have a triangle that's forming, right, in which you have highs that are squeezing in and lows that are squeezing in, right? And these are 2 major support and resistance trend lines that have been forming since February and March of this year. And what you can notice is we actually had some severe bearish divergence in RSI, right? So these 2 points of RSI were higher, yet our highs in price were lower, signaling that this move wasn't as strong as prior moves. And as we can see, it exhausted back down. Ultimately, we went ahead and created a new low, in which now this creates our support for RSI. Notice we are experiencing some bullish divergence that played out, in which the lows here are getting lower, but we can see RSI lows are getting higher. which led us to break this trend line in RSI on December 2nd. As you can see, that was right around here when we broke it. Now, typically speaking, whenever you break trend lines, you often go on to retest them. So as you can see, we went on to become overbought in RSI, as well as retested this trend line that was created from that bearish divergence prior. Ultimately, from here, what you want to be looking for, now that we've rejected off of this resistance that we've continued to develop over the time frame, we're going to want to look to see how price reacts as we go on to retest this trend line that broke, as well as we go on to retest 50. General rule of thumb when working with RSI, if you're trading above 50, you're in an upward trend. If you're trading below, your chances are you're in a downward trend. Now that we've broken to 50, we're in our uptrend. And so we're really going to see, or likely see RSI come back down to 50 and right around this support. And we'll see if it holds. If not, it likely comes back down to test this support from the bullish divergence we experienced in early December, right? And, between this RSI support line, the 50 and the trend line that was broken, along with, these various support lines below, these should be some helpful reference points to avoid any unnecessary risk and loss. Ultimately, our risk reward structure is very close in line with that first support. If you do see this break, maybe that's a good spot to cut it loose, theoretically speaking, if you were to play this trigger. But another active support to think about is the 200-day moving average, right? So these are likely going to work in connotation as MA begins to increase and price moves closer to this support line. So really keep in line to make sure it holds from there and it holds in our RSI levels here. And ultimately, if you're just a bull, you're going to want to see this trend line break, right? So maybe we go on to retest this support zone, come back to try and break it again, and ultimately successfully break it. Once it finally breaks and we sustain a continued move, this is generally a sign of continued bullish momentum. And so that's really what you're going to want to look for and want to see if you are a bull in this market. So the last ticker I want to talk about today is Oracle, which falls within the infotech sector. Oracle is a technology company that provides software, cloud services, IT infrastructure, and hardware that organizations use to run their core operations. Amidst the AI rave that we've seen over the year, energy and compute power demands have increased along with it. Rather than hosting operations on a local drive tied by fixed performance capabilities, hosting it on a cloud infrastructure allows for efficient expansion of computing power when needed. And with such a heavy energy and compute reliant environment AI is creating, Oracle is positioned powerfully to capitalize on the trend. Should AI continue to drive value and pan out to be the moneymaker and positive influence everyone is anticipating. Now, Oracle recently reported a mixed earnings release on November 30th, with a GAAP EPS up 91%, revenue up 14% year over year, and specifically cloud revenue up 34% year over year. They reported a remaining performance obligations of $523 billion, which is up 438% year over year. This is a crucial metric for understanding future revenue, especially in SaaS, the method in which Oracle commercializes its business, which represents the total value of contracted services or products not yet delivered. To clarify, SaaS is a method in which software is licensed and accessed online via subscription. Oracle's ability to capitalize on this AI boom has already shown so far with their impressive growth metrics. However, Oracle recently experienced a pullback due to an increased CapEx forecast by $15 billion to around $50 billion to fund its AI center build-outs, much higher than analysts expected. And in addition to this, the high spending resulted in negative free cash flow of $10 billion for the quarter, raising investors' concerns about the sustainability of its AI investments and potential margin pressures. Lastly, they slightly missed revenue expectations, indicating to some that the high spending costs are taking longer to translate into realized revenue than anticipated. Now, in an environment like what we're seeing today, where AI and tech stocks have been pulling back heavily given concerns around debt load and capital expenditures related to R&D of AI, a tool I really like to use to help catch the falling knife, if you will, is a strategy called mean reversion, which measures how far price will deviate from a moving average and find consistent levels in which, at that extreme, price tends to reverse. So in this case, we're viewing when Oracle drops more than 19.3% relative to its 100-day moving average, which in the top panel you can see is the orange line. And ultimately, over the past 10 years, we've seen a dip this low, below the average 4 times, in which across all 4 times the price was higher when looking 99 days out. And the price was higher on average 83.5% across those 4 triggers. Now we recently have seen a 5th and 6th trigger that occurred on November 24th and recently on December 12th. And when looking at the historical reactions on top of each other, again, the x-axis is trading days out from the event. Y is the cumulative percent return over that 100-day period out. We can see that blue line is the average, leading up to 83% on average on the 99th day. When looking at all historical reactions have been realized, excluding the 2 active triggers in yellow, we can see that for very little time of the duration of every trigger, it ended up negative, which is, at least historically, a really good sign that we may see similar positive performance again. Now, the trigger that occurred on the 24th is currently on day 15, down about 6%. As we can see historically, some of the lowest drawdowns over the first 20 days we experienced was roughly about 10 to 9%. And ultimately, the second orange trigger is a bit hard to see, but it's on day 2 and it's roughly about break even. And you'll better be able to visualize on the next slide what that sort of return could look like if we do end up closer to that average return on the 99th day. So here we have that 83% average return plotted out in terms of a P&L structure, right? So I have a 3-to-1 risk structure set up in which we have 83.5% at the top and roughly about 27.5% at the bottom. Now it's a much larger risk tolerance, but that's only because our average gain was so large on the upside. Ultimately, whatever risk structure you'd want to set up, if you were to theoretically play this trigger, is up to you. But generally speaking, a lot of investors go by the 3-to-1 rule to ensure as long as they perform above 25%, they are able to break even. Now, I've also gone ahead and plotted some support and resistance points that will help navigate alongside this reference of what has historically occurred. Now, the first thing I want to point your attention to is we had some bullish divergence that we experienced at the beginning of 2025 between January and leading into mid-April, in which we had lower lows in price, but we had higher highs in RSI. And as you can see, we bounced off of that RSI strength. And ultimately, if I were to extend this trend line out, you'll see that we ultimately attempted to come back down and came very close to that support line, but ultimately did not test it or break it. And ultimately, we finally experienced some bearish divergence, right, where RSI was experiencing lower highs, but price was experiencing higher highs, in which we exhausted down to finally ultimately break that bullish divergence support that we created at the beginning of 2025. Now, it was very short-lived. As you can see, we spent maybe a month underneath it, attempted to break back above it, and now we're back below. Now, if I take off that extension for now, point you to the second support, right? So we experienced bullish divergence in April to November, in which prices experienced higher lows, but RSI was experiencing lower lows. Ultimately, you can see we bounced off that point in November. Unfortunately, we went on to break this trend line and it failed the retest. However, I noted last video, whenever you have RSI break 30 and then it goes on to hold the 30 level and bounce off, this is generally a really good bullish sign. So from here, what we want to see is price continue to bounce off, ultimately break this resistance that was one support, and start trading back above this trend line, within the next couple of days, to show us a sign that this trend is continuing and we haven't fully broken it and are outside of that realm. I've also noted there is a gap that occurred that finally has filled. I also mentioned in the video before, whenever you have gaps that occur, chances are the price is going to come back to fill it later, right? And so as you can see, we had an unfilled gap that has now been filled. Ultimately, this could be a really good support line alongside this bullish divergence support. As a reference, if you don't want to have such a big loss appetite, right, this could be the cutoff if you want to have a stricter risk-reward ratio. Last thing I want to note, should price begin to bounce back and we start to see some bullish momentum, there is another resistance you want to pay attention to, in which we're forming a trend line in RSI. When we bounce off, we're going to want to break this resistance that likely will fall in line with resistance of our bullish divergence that we experience over the course of the year, right? So hopefully these levels help in navigating this trigger should you want to play it. Lastly, when working with mean reversion, especially when the 100-day MA trigger occurs first, I always like to look at levels relative to the 200-day moving average, as well as the 200-day moving average tends to give a bit more consistent and reliable triggers than the 100-day. Even the 100-day is a bit faster acting. But ultimately here we can see Oracle versus the 200-day moving average. And similarly, whenever Oracle drops about 16 to 17% from its 200-day moving average, this tends to be the level in which the extreme rebounds, right? Currently, we're down about 13% from the 200-day MA. So realistically, if we were to drop another roughly 3 to 4%, that would put us in the realm of that threshold that we're viewing in the bottom panel in green. So that's just something to bear in mind as well. While the 100-day indicated an early trigger, right, you may want to wait to see if the 200-day triggers as well, as I like to typically use both of them in connotation as a confirmation. Ultimately, should we see a trigger for the 200-day MA in which it drops more than that 17% roughly, we tend to see about a 40% average return over the next 86 trading days at a 90% winner rate as well across 10 triggers rather than just 4. So you have a bit more of a larger sample size to gauge off of. Significant metric to mention here is the profit factor of about 16.73. We'll just call it 17. So that just means, historically speaking, the wins were on average 17 times larger than your losses. Ultimately, if you were to continue to perform that profit factor, even if you're only to perform at a 6% win rate, you would break even, right? In which, I mean, if you look at the top row, you're seeing the average loss, and that was ultimately the one time the price was lower, it dropped about 2.89%. And visualizing the reactions, we can see the most recent trigger that historically finished out that occurred back in around April of 2025, and ultimately on the 100th day it experienced about 150% return. As you can see, based off of historical reactions, you're not seeing much downside risk relative to the upside potential, making this a potential opportunity to capitalize in the market. Okay, so last point I wanted to make today, looking back at Oracle, right? If we were to see that roughly, let's say, 6% drop, that would put it closer to 171. Yeah, let's say 173.25, just about, right? If we take it a step further, go down about 10%, that would put it, closer in line with, around 23% below. Some of the most extremes we saw relative to the 200-day moving average. So ultimately, this could be another opportunity. I'll be sure to keep you in the loop should we see that 200-day moving average trigger. And that is all for today. If you enjoyed the video and liked what you see, please like and subscribe. Maybe comment down in the video what you thought about the triggers, or maybe some other tickers you've been looking at that you found interesting in the market. I hope you have a rest of your day/night, and hope to see you next time.